Well, good afternoon, everybody. Thank you for your participation in this session. My name, as you can tell, as the only Lawai in the group, is Patrick. I'm a director at KPMG, and I spend a lot of time focusing on corporate innovation, but also more broadly, what is the role of Hong Kong and China as a leadership, as leaders in technology, and how do companies, both existing and emerging, respond to innovation. I'm really delighted to host this panel. We want to keep this short, sharp, want to make it potentially controversial where possible. I'm conscious that there are so many of these panels where you'll be listening to the same sorts of information, and we want to challenge all of our panelists, and they've signed up to this, to be able to go through and participate. We will have time at the end for Q&A, so keep all of your curly ones ready for us and keep everybody on their toes. But without any further, any other further time, I'd like to introduce Cynthia, Melvin, Wayne, and Henry. Cynthia, just over to you. Do you want to introduce yourself just quickly?
Sure. Hi, everyone. I am an angel investor, investing in early-stage technology companies, and I also help them opening up the market as well as strategic financing in the companies that I invested in. And previously, I was a sell-side analyst covering China technology, telecom, and internet for over 11 years. So this is the field that I'm focusing on all the time.
Melvin?
Hi. So my background is in private equity and technology. So I started off in the private equity world and then became an entrepreneur, founded a tech company, and then also founded Starlake Capital, which is a principal investments firm that helps technology companies and private equity funds raise capital in Asia. So that's a little bit about me. I'm based in Hong Kong, but also frequently go to China and potentially relocating to Shanghai very soon.
I'm Henry. I run a fund who invests primarily in hardware. So it could be underlying component, sensor, power, microprocessor, to end product in Industry 4.0, advanced manufacturing, health product, etc. Most of our portfolio are based in the US, with some in Israel, some in Europe. The idea is to help them manage and sort out the manufacturing issue in China and help them find potential revenue stream in China.
Hi, everyone. My name is Wayne. Pleasure to be here. I work for Mindworks Ventures. We're a local venture capital firm. We've been around for 4 years. We manage 350 million US across 3 funds. So we're active mainly in Asia Pacific with a greater China focus.
Thank you. Look, I thought we'd start off with BAT. Now, there was a time in my childhood when BAT only sort of terrified Bruce Wayne, but the Baidu, Alibaba, Tencent dynamic is really reverberating around the world, and I think a lot of investors are trying to figure out, and entrants are trying to figure out how to respond to that. Cynthia, starting with you, what would be your perspective?
First of all, Baidu, Alibaba, Tencent, and to a certain extent, JD, they have their own specialized verticals in e-commerce, in social, search advertising, and also smart city IT services in the cloud services. So they already have the established verticals. So for startup companies, they should first of all try to work with these companies and leverage all these platforms as much as possible. And in certain cases, if there is a high technology entry barrier at the startup, they can potentially think about position themselves as an acquisition target or a partner.
And Melvin, from your perspective, we were talking about this beforehand. There's something quite unique about the conglomerate structure of those businesses. Do you want to just talk to that point? And then, again, how should people consider understanding that model as a vehicle for entry?
Yeah, so in China, the conglomerate model is very unique. So in the US or in other parts of the world, you have technology companies that are typically pure play. So if you look at Google, or if you look at Amazon, or if you look at Apple, they're very pure play in that they focus on a specific area. In China, you have conglomerates like BAT, they're all conglomerates, and some of the other groups that are investing in tech, they essentially become conglomerate-like. Now, I don't want to go too far into why that is the case. It's partly to do with the governance structure model and the political structure in China, but also with which means there's a closed market. But also, it's because it's such a big country, so then you get significant economies of scale from a distribution operational perspective. And so you do get these conglomerate-like technology sort of behemoths that emerge. There's really breaks down into two categories. One, which they started with technology as their core. So say Baidu would be one, or Alibaba, which slightly more peripheral. And then you have another type, which is really started off with asset and assets as their core, and then became investment vehicles. So if you look at Fosun, or if you look at Ping An, or if you look at some of these groups that are becoming players in technology, they're emerging from asset and investment rather than from technology. But nevertheless, you have these technology conglomerates which are emerging and being very competitive in their ability to acquire companies given synergies and their ability to capture the market through distribution scale.
Wayne, when you're thinking about investments, what are your sort of guiding principles about how to tackle the bats?
It's a bit of a cliche, but the way we approach it is, if you can't beat them, join them. That's the approach we take, both from a co-investment perspective as well as teaching or strategizing with our portfolio companies how to approach the landscape. So from the co-investment perspective, we do work quite closely with Tencent and the various facets of Alibaba to do co-investments or help them find early stage companies to invest in. And then from the portfolio company perspective, I think a lot of companies where we met an Australian fintech company and they were like, my mission statement is to be the WeChat of Australia and then expand into Asia. But for us, I think a much better strategy would be how could you pivot your product so that it becomes so important to help WeChat become the #1 mobile payment firm in the world. You become so valuable that they must buy you out in a later stage. That is an easier way of growing the business. Rather, be a complement or enhancement rather than a threat to them. That's usually how we play it.
Henry, from a physical asset perspective, are you finding that that's a similar strategy that's sort of working?
Similar, but at the same time, to Melvin's point early on, right? If you look at Tencent, Alibaba, Baidu, they all focus on very different vertical. But one thing that if you look from a hardware lens, they are kind of converging. You notice that since Amazon came over with Alexa, they suddenly realized that, there is actually a new product that could be the potential pivotal point for customer to touch the internet, which is a smart speaker, right? Now, Alibaba has one, JD has one, Xiaomi has one, Tencent has one, Baidu has one. Everyone has one, right? If you look at how Tencent and Alibaba become so successful, before the mobile internet, Baidu was actually the king, right? When mobile internet comes out, they realized mobile become the only conduit to connect to the customer. But 5 years down the road, what would that be, right? Smart home is actually could be one category. Smart car could be one category. That's why you see both Alibaba investing in electric vehicle, Tencent investing in Tesla, investing in Lilium. So from our perspective is that we look at a broader trend. We do feel that hardware is going to have a very fundamental change to the internet landscape. And that's why we actually spend a lot of time in enabling technology, right? So the underlying component, underlying really core technology that could go into any hardware that could be branded by any of the Chinese behemoths.
Yeah. And of course, the technology is interesting phenomenon there. But we were talking about this before we sort of came up on stage, the O2O model as well as an entry point. Just sort of open it up generally. What are you seeing as the sort of key differences from an O2O perspective? I'm thinking sort of Amazon on the one side compared to the Chinese behemoths.
I think this is already converging because Alibaba, since already 2 years, have been operating Hema, HEMA, It's an offline supermarket, has been really, really successful, especially in the city of Beijing, where they would deliver any product of any value within 3 kilometers. And this value proposition is very effective for customers. Even if they order a can of fresh milk for 3 yuan, it can be delivered within 30 minutes if you live within the radius of 3 kilometers. And this has enabled the success of Alibaba, and also they beat the used to be unthinkable success of logistics capability of JD.com. And then there's also, needless to say, a lot of scale economy from online to offline in terms of sourcing, supply management, all kinds of benefits. And I think they are scaling up already on a nationwide basis. So we see that in China, but several years ago already, Amazon bought into Whole Food. So it is converging.
I absolutely agree with that. The only thing I would have to add to that is that you're not just seeing an online to offline phenomenon. I think now the other value add to that O2O is also the brand. So you're seeing Chinese companies acquiring brands that also come with a user base, existing captive audience that is allowing them to do two things. One is expand overseas, but also bring with Chinese products, but also bring those consumers to China. So that's another trick that Chinese companies are using, especially when it's more on the more coming from the other side type of conglomerate, which is more capital and sort of asset conglomerates acquiring brands.
So I'm going to challenge you on this one a little bit, just around brand equity, because again, the environment is so turbulent, as I see it, that customer loyalty is actually much lower. They might be loyal potentially to the platform, but not to the brand in the same way as you might be, say, in the West. If you have a particular affiliation with a breakfast cereal or a type of shoe, then you get into a buying behavior where that's always the case. I don't see that in China, because there are so many new entrants into these markets all the time. From an investment perspective then, how do you invest and provide counsel so that the companies can remain relevant and the top of their game with or without a brand equity behind them?
I guess the way or the perspective you can look at it is a lot of the Chinese consumers, it's loyalty or repeat usage based on utility or function rather than brand. So, you use WeChat once, you use Taobao once, you just keep on using it. You're not particularly loyal to a brand or the brands, but it's because, it's the best utility, it's the fastest, most efficient, and cheapest, hence you use it. And I really think, as much we say, we keep on saying the Chinese are chasing, the Western markets in that respect. This sort of positioning for product and websites is something which the Chinese have done the best.
And are you seeing that those closed ecosystems are becoming even more powerful and more successful? I mean, again, once you're sort of in the Alibaba environment, then you start to be able to use services in all sorts of different ways. How are you seeing that sort of play out? Anybody?
I think from a consumer point of view, of course, they want to get the best of every category. So if that is available from one single platform, then great. If not, then I would use, I buy everything from Alibaba, but in terms of social, I stay with Tencent. So this is from a consumer point of view. But then from a supplier point of view, the platforms like Tencent and Alibaba, they want to capture the time, the browsing time, the resources of all users as much as possible. So I even remember in a 6-7 years ago, I asked senior management of Tencent, why do you even go into e-commerce when Alibaba and JD has 95% of the market share? Isn't that a lost game already? And then they said, if we don't, then it's even worse. Our users will definitely buy from other platforms. At least if we try, there is a chance then they can buy from us. Of course, in the end, it's a subscale business, so they decided to swap it with JD, and then it was a win-win situation. But the original thinking was this.
So I disagree with that a little bit in that I think it's very important to have your core, and I think if even as a platform, if you deviate too much, there's going to be someone else who does it better, and then the consumer will go to that platform. So a good example is, say, Amazon Prime. I love that because the only reason, I think one of the main reasons Amazon's been able to grow so quickly in the last year or so is because they've become almost like a conglomerate model, even though they're a US company. So they're essentially a service where you can get your cinema, your online deliveries, your groceries, a whole host of services, but they're targeting a specific type of audience. So they're not targeting your sort of lower level. It's more on the premium end of the market. So I think these platforms need to think, who are they targeting, and they need to be targeting the right focus of audience. If you just try and target everyone, you get lost in the noise, and that's just a very private equity sort of approach. But I think if you think about it from a consumer perspective, if that platform is selling you premium and non-premium, and a bit of this and a bit of that, it doesn't have the same resonance as a platform that is the go-to brand for sort of premium or for mid-market or for value.
But if you look at both Alibaba and Tencent, right, they also approach the market a bit different. Alibaba, when they do investment, when they do acquisition, they tend to take out the entire company. They tend to mostly focus on e-commerce, right? Yeah. Tencent takes an even broader ecosystem approach, right? They are very friendly with Meituan, right? And they're friendly with a lot of other sort of large conglomerate, right? So they recognize that to one point you have so much traffic on WeChat, but on the other hand, WeChat try to be everything but cannot really be everything. And that's why they don't mind supporting some other mega player like the Meituan of the crowd so that they could work together, right? So I think even a couple years down the road, yes, Tencent and Alibaba will still be the very sort of the dominant internet player. But there's still a couple relatively big 20 billion, 30 billion, 40 billion company will still be around and offer the choice to the consumer.
So the Chinese market, about 1 billion people, give or take, but and extraordinarily differentiated to the rest of the world. That makes it difficult to enter. But I'm interested in the challenges and obstacles then for Chinese companies that understand that closed market, then moving out to the other 6 billion in the rest of the world. Again, continue with you. What are your view from a hardware perspective about firms? Are there particular investment strategies, business model strategies that you're finding Chinese companies find difficult to come to grips with as they go outbound?
Well, from our fund, let me touch on both inbound and outbound. We invest a lot of a US company that try to get into China. So the way how we look at them is, look, right, if you just have a piece of hardware that could be copied by Shenzhen within 1 month, well, we won't invest in them. But if you have the underlying core technology, they will believe you cannot be reverse engineered. They will believe that Chinese would actually buy that, which, to be fair, I think a lot of the Chinese company, whether it's the large tech company or a lot of the even old corporate, they would like to get access to the high-tech, advanced technology from the West, right? So that is actually our strategy. Vice versa, to your point, when we try to look for actually hardware companies in China, they tend to, number one, have less of a hardcore technology, right? Same thing, when you go out, you get copied. Or even before you go out, you get copied already in China, right? So Chinese, at least hardware companies, tend to focus more on application, more on services, just like the software brothers, right? So we find it, at least from a hardware perspective, pretty hard.
So I think it's just a challenge again. So I just find it hard with hardware. What can you have that's really deep tech hardware that someone can't figure out eventually? That's the challenge of, I think, bringing overseas companies into China. It's so hard because the technology in China now is so good in that there's almost technology being exported. Is that, if you bring any piece of hardware, I'd challenge you and say, that it won't be copied within 3, 4, 5, 6 months.
I can give you an example. Well, glad that you asked. Right? It's almost like a setup question. Thank you. So what I have here is actually one of our portfolio company. This is our first product. It's a smartwatch. But this is completely powered by your own body heat, right? So they develop a module called thermoelectric. The concept is to capture any wasted heat energy around you, convert into electricity. So this company, the underlying technology is not in the watch design, which is very, very simple, copy in 2 weeks. It's not in the different sensor, but it's the underlying core design of the thermoelectric module. Then when you look at it under the microscope, it's just a bundle of silicon. But what process do you go through, what chemical process do you go through to achieve at the best efficiency of the thermoelectric? It takes months of R&D, right? Well, probably, I would say that it's fairly hard to copy. It might take a scientist maybe another 6 to 9 months to reverse engineer that, if maybe possible, but that gives us enough leeway to actually continue to improve our underlying technology, right? So that's what we mean by the underlying core technology as opposed to just a piece of, I guess, hardware.
Wayne, Penny, for your thoughts, how does this sort of fit in your investment strategy?
Difficult for us to answer because the typical Chinese company that we would invest in does not need to go overseas to succeed. I mean, yeah, I mean, there's 55% internet penetration rate in China, another 20%, if you get to US, that's another, 2.93 billion people coming online. Most of the companies that we invest in will not have to go into the US. And to sort of counter even the notion of it, I mean, a couple of weeks ago, people in LinkedIn were posting, videos about Amazon shops and, automated unmanned shops. We've had this in Shenzhen in China for years, we invested in this manless food machine with Tencent. It's been around for 2 years. These companies, if they hit their KPIs of 200-300 cities in China, they'll already be worth 5 to 10 billion US, and that's enough for us.
Yeah, I agree. The Chinese market is so huge that any company, unless you get to a certain stage, you don't need to start looking out. But some companies are at that stage where if they do not look at globally, in 10 years' time, their growth will not be at the same rate. However, it's almost as hard for Chinese companies to go out as is for foreign companies to come in. Not as hard because of the system, but the way I see it's getting done is more inorganic acquisitions, and then in complement to organic growth. Because organic growth is just too slow. There's still some of those format differences, still some of those language differences. So I think the main mechanism is going to be by well-structured, synergistic, inorganic growth, where there's actually synergies that can be unlocked. And the problem is a lot of Chinese companies do that often without the strategic synergy part, and then realize that they can't realize these synergies and end up paying too much and or being told to sell that asset by the Chinese government.
In the the public market, you already see Tencent and Alibaba having been expanding overseas quite successfully. Actually, Tencent expressed their intention to globalize and go into the international market with the games business. What they did wasn't to simply move the games overseas. They actually invested in many successful international game companies in Nordic countries and in the US, and now management let the portfolio companies do their job and just periodically on a quarterly basis visit all these countries and exchange ideas and see what kind of resources they can support these companies. This is how they did it, and that has been, I think, very conducive to their business overall. So this is, success in obvious kind.
Yeah. No, an excellent point. Now, I want to open it up in a few moments for questions. So just time for one last sort of perspective of inspiration. Again, we'll sort of come down, start with yourself. What would be the one key takeaway that you want the panel to be thinking about that they're not already thinking about today?
Just relevant, I guess, to today's topic. I know some startups and some fundraising companies are here today, and we spoke to a lot outside. When you're navigating, China tech giant ecosystem, which is sort of like the topic today, I think one mistake that people do is they sort of classify when they talk about BAT as like, oh, I want Alibaba to invest in me, but they don't really, do the homework or find the resources to find which particular group within the conglomerate is relevant to you. So Alibaba, there's Capital Partners, there's the BVI holding the list codes, there's Blue Pool Family Office. Any of these have multiple hundred millions of US dollars. And the stage at where you're at, the type of business where you're at, or where you want to expand, that may be very different to you need to find the correct person to talk to, basically, yeah.
I would say you could also look beyond BAT. I mean, if you have the three companies combined, it's still just a fraction of the economy, right? There's still a lot of even market cap $5 to $10 billion company. There's actually tons of those, right? Have been around for past 20, 30 years in the traditional industry, but they are now actually quite open-minded to work with foreign startups to bring the technology into China, right? To the point, of course, if your underlying technology is easy to be copied, then you should think twice. But if you're not, right, if you believe that maybe you have a couple months and then you can leverage that channel to break into the market, at least get some revenue, that's actually another route.
So I think China is so important now, and it's going to the acceleration of there's going to be an acceleration of growth because of the concentration of data they have access to, the lack of privacy restrictions. So it's not just going to be that China is going to continue growing with regard to some of the other markets like Southeast Asia or Latin America. It's going to accelerate, and to that extent, as that acceleration happens, Chinese companies are going to start to come overseas and look for investment opportunities, look for partnerships, and so to that extent, I think that's the next wave. But in terms of doing business in China, making investments or finding partnerships, I think it's really about relationships and going to the right person, really understanding what the strategic thinking is within that company, but also within that business unit or within that team, because it sometimes changes. And so if you really want to do China, you really need to be on the ground or work with people who know what's happening on the ground, not just in Hong Kong, which is why I'm moving to China.
I would say think out of the box. I see many entrepreneurs today from overseas. There are examples of successful Western companies who just focus on what they do very best and try to achieve scale. Keep an eye on the China market, and because I talked about my investment in a fashion e-commerce company 3.5 years ago. They started in Hong Kong and then moved to Paris. This is the fashion capital of the world, and then they achieved scale. So now the biggest shareholder is Alibaba, who has the ambition to go overseas, but it takes time for them to globalize. And so in the interest of the time and achieving scale and lead to cut the time to market short. So they not acquire, but made a big strategic investment in this company. And then on the other hand, from the company point of view, they didn't have any edge in China. Now with Alibaba, they are going to be able to target China and work together. So this is what I mean by thinking out of the box. And if you achieve the scale and do your best in your category, there will be lots of opportunities.
So think different, be local, do your homework, and strap in. I think were the key takeaways. We've got about a minute to go. It's time for a question or two.
Along those lines, I've heard from a few companies that have taken investment from Alibaba and been kind of disappointed with the results they got from it. Everyone thinks it's like the panacea, but actually 10 million from Alibaba is not going to get, they don't really care. It means nothing to them at the end of the day. And people have kind of overestimated, oh, they're going to get me into China and all this stuff. Is that something people should be cautious about as well?
It's always something that companies should be cautious about. At various stages, I think the challenges are different. So after strategic investment from a big company like Alibaba, there still need to be lots of work to make it happen, and to work with the other party and achieve the vision that they originally had. Of course, there is always the challenge.
I've got colleagues who've done the same, raised money at this seed sort of round. That's just seed, that sort of spray and learn money for Alibaba, so that they're not going to really come in and really help you operationally. When they come in and help you operationally, it'll be at a later stage. So the stage at which they invest will dictate that, and also the stake they take. So typically, when they're really serious about you, they'll take a controlling stake, in my experience. But it's not saying that it's not good to get money from Alibaba. It's absolutely good. I think you'd also have to be careful about them just not helping you operationally, or even just using you as to learn and just replicate your model, perhaps. So just, I think, just the caveat.
Yeah,
Quickly.
You know, of course, this is you cannot generalize, but 2 months after the closing, the transaction volume already went up 10 times compared to last year, whole year. So this is the difference. But I think the key is still the people, who you are working with and who can make it happen.
So, unfortunately, we're out of time. I think we want to run it pretty crisp. The panel will be available outside. They do accept drinks, I think. Really, thank you all for your attendance today. Some great insights. It's a tremendously exciting space to be playing in, and I wish you all the very best of success. Please join me in thanking our panel.